Welcome to the current federal tax developments for the week of December 16th, 2019. Current federal tax developments are brought to you by Kaplan Financial Education and your state society of CPAs. This we're going to take a look at some of the developments that occurred in the week in taxes, including the IRS giving some relief that probably a lot of people be happy we have in the area of the partnership tax basis capital account reporting, as well as the IRS not saying anything about a particular workaround for the state and local tax issue, and the questions being raised as whether or not the IRS's silence on this is an indirect acquiescence for the IRS in accepting that these systems are going to work, or at least that there's no good way for the IRS to try to shut them down that would be effective. So we'll talk about those things coming up. Now, the coming week, we are going to have a few things happening. First thing is, I do have a Cal Society broadcast coming up on December the 20th. This will be multi-state taxation of businesses. We'll be running that at 6 a.m. Pacific and 8 a.m. Pacific on the 20th. So if you want to sign up for that through your state society. Also coming up before the end of the month on December 30th, a rebroadcast of Assisting the Survivors of the Decedent's Estate. Again, this counts as live CPE under NASBA rules. It'll be at 6 a.m. Pacific and 8 a.m. Pacific. Just that for your state society. Again, I should say maybe not most, but many state societies have an agreement with CalCPA to provide these to their members using their members' discounts. So you want to double check to see if your state society is offering these programs, and if they are, look at signing up for them if they're of interest to you. Let's go ahead and start with our first development of the week, which is Chief Counsel Advice 2019-49001. This was issued on December the 6th of 2019. This advice deals with an issue that goes back to Executive Order 13765. That order, issued early on in the current administration, was meant to require that the IRS and other agencies essentially utilize their discretion to provide relief from various ACA provisions. Remember that this is kind of the intermediate. It was going to take effect until such time as we had the ACA repeal. Obviously, the repeal didn't quite go as expected, so we ended up with this. But our question now becomes, in this case, this is a taxpayer. The taxpayer went to the exchange. The taxpayer qualified for an advance credit on his premium. It turns out, however, that they hadn't considered the fact that the taxpayer during the year was going to receive a lump sum payment of Social Security, apparently because the taxpayer had been applying for disability benefits. Those benefits hadn't been paid during the period while the Social Security Administration was considering his application. When they finally do pay them, suddenly they all drop in at once into his income. And as you might guess, that caused his household income to soar a bit. And when that happened, he no longer qualified for the subsidy he'd received, and he needs to repay a significant chunk of change to the government. Well, he was saying, you know what, I think that executive order allows the IRS to, take care of me. It should solve this problem. So even though I supposedly have to pay this back, I think that order means that the IRS should be able to grant me relief on having to repay these amounts. Well, the IRS wasn't quite so sure. Here's the problem. The executive order only allowed the exercise of authority and discretion to the maximum extent permitted by law. The problem from the IRS's perspective is that the law here is very clear. If your income is above a certain level, you're required to pay back if the exchange gave you a credit, an advance credit, which, as you have to remember, in the view of almost anybody who's not a tax person, what they really got was they got a premium quote. They didn't actually figure out that it was a premium quote reduced by a credit. They just know how much they had to pay per month for the premium. Well, but nevertheless, if that subsidy you receive turns out to be more than you would qualify for, we get to the end of the year and compute your credit, you have to pay that back. As I noted, the law provides no discretion to the service in this area. The IRS said, look, the executive order did not create some brand new authority for the Treasury. Rather, it said to the extent we had discretion, we were to exercise it to minimize these numbers. We don't have discretion here. With no discretion, sorry guys, but you're just going to have to pony up and pay the entire cost of the coverage because you had income that pushed your household income up to the point to where, according to Congress's view, when they pass the ACA, you're no longer eligible to receive a subsidy. So interesting problem. And again, don't go outside. This is a catch sometimes when clients or even CPAs sometimes read these announcements that are most often let's face it, in a political climate. These announcements are issued and people don't pay a lot of attention to the details of what's going on. But unfortunately here the details matter, and the actual order is very clear that it's not going to give the IRS any authorities they don't have. In this case, the IRS position was, we don't have any authority. So, tough luck for the taxpayer. Next up, this is not the kinder, gentler IRS in this notice. This is Chief Counsel Advice 2019-49019, also issued on December the 6th. And this particular, not kinder, gentler IRS ruling looks at a problem when, we're allowed to, under Section 132, provide our employees with up to a limited amount per month a transit pass that they're able to use to cover their commuting costs. And that can be excluded from their income. In this case, and we had a revenue ruling, 2014-32, that specifically dealt with transit passes as opposed to straight reimbursement of the employee. And 2014-32, if you follow it, allows the company to go get transit passes, debit cards, other items that could be used to pay for the commuting costs, pay for that, for the transit. And the idea is that's going to be a lot simpler for the employer than having to do all these reimbursements, get all these records. So employers are generally going to like this. But here's our question. What happens if the employee goes in, they're going to get ready to ride the bus or the train or whatever into the office. They walk up to the turnstile, and their transit pass fails. Their debit card fails. It shouldn't have failed, but it, for whatever reason, maybe the machine's fouled up, maybe the system just isn't quite working. Who knows what the glitch is? But for whatever reason, it doesn't work. Now, in theory, the employee could, of course, go look for a customer service agent and resolve the matter and get it put on the train. However, a couple of huge problems with this theory. First problem is that in many locations, you're not going to find a customer service person to go talk to. You may be able to talk to the bus driver. That's probably not going to go too far. So that seems like not a good deal. Secondly, even if you were to get it, it would take forever. We'd be up there in line with the agent going back and forth and trying to resolve things. And it would be 25, 30, 40 minutes later. Maybe then you'd get on a train without having to pay. But you'd also be 40 minutes late for work, which is going to be a problem for you as an employee. You would prefer not to be that late for work. So the most obvious solution for the employee is to grumble about how technology doesn't always work, but then just go ahead and pay for a standard fare. And when they get to the office, go to HR and say, hey guys, this card you gave me didn't work. I wasn't able to use it. I had to pay. Here's my receipt. You guys reimburse me. Question, can they do that? Can they reimburse the employee for the fare paid in this situation? That was what was put forward. Now, obviously, they can do it. So our real question becomes, if they do it, do they have to add that in as taxable wages on the employee's W-2 and also pay all the payroll taxes on it? The IRS says, basically, you can't exclude it. You've got to include it in income. The employee had the right to seek reimbursement from the transit authority. Yeah, that's going to work well. And because of that, the IRS position was the card was available to provide transportation. That's really their test. Was the card available? Was the right available? It was available to the employee. The employee could have taken other actions to have ensured that they used it. And rather than the employer, because the IRS theory is now we're kind of doubling up. They already were paid. We were paid for this trip. But now we're going to turn around and give them more money to reimburse them for the failure of the card. IRS position is, sorry guys, that's taxable if you're using Revenue Ruling 2014-32. Now, obviously, if you're just flat out reimbursing transit every day up to the monthly limit, this is not really a problem. but that's not what you're doing here. In the IRS position is you already gave them the transit money for today. Giving it to them another set of transit money for today means that should be taxable, right? Now, the ruling does say that if truly the card is not available, because they may give an option like you have a new hire employee, it may take 2 weeks to get a card issued for that employee. Well, if that's the case, then for those 2 weeks, you can pay them for the actual transit bills they pay. That's fine. But once they're issued the card is available, then you're stuck with this rule that you cannot reimburse. Now, as I said, this is hardly the kinder, gentler IRS that we've been promised from time to time in the past. It is a much nastier IRS, shall we say, which certainly isn't giving any leeway in a case like this. Presumably, the case that gave rise to this, where we got the chief counsel advice, presumably there was a lot of this going on, and it was going to be significant enough to raise in the exam. I got to assume, I don't care if it's only one guy who got reimbursed one day out of the year. I probably would care less, and I probably wouldn't waste my time even trying to defend an assessment against that one-time charge. But if you've been doing it a lot, and apparently somebody probably had, it could become expensive. Presumably that's what happened here. It became expensive, and now we got an issue. This week, we finally found out what that state tax, or what that quid pro quo and potential state tax set of proposed regs that were going through OIRA become. This was issued here on the 13th. It's regulation 107-431-17, proposed regulations under the rules for charitable contributions and state and local taxes, right? How we do that. Now, the issue was, here's the catch. Most of what this ruling deals with is the fact that when the IRS, during the time we was pending from proposed regs to final regs, and with the final regs itself, the IRS issued two pieces of sub-regulatory guidance. That is, guidance on the issue that was not part of a formal regulation, but was an IRS, basically a revenue ruling or a notice, a revenue procedure or a notice, that was allowed to be used by taxpayers to implement how this whole deal with the tax credit reimbursement problem would go. Remember, the issue here is one of the workarounds we had early on for the $10,000 cap on state and local taxes that was proposed by a lot of states was to go ahead and set up these charities that you could contribute to, like, let's say, a New York State Education Fund. And if you made that contribution to the charity, you got 70%, 85%, some percentage of that contribution to the charity as a direct reduction of your state income taxes. The concept being that when that happened, the reduction to the income taxes, you were already way over the 10,000 limit, so you didn't care about that. But you would be able then to go around and treat that as a charitable contribution for the month, for the year. And charitable contributions, while they're limited, cash to 60% of AGI, otherwise 50%, that's usually way more than $10,000. And for anybody who is just $10,000, they probably don't have a tax problems to begin with. So effectively, it's much better to have these as charitable contributions. The IRS had ruled in the past, of course, that this was going to work in a chief counsel advice under the old law. They backed off that early on. And then we had to issue a couple of rulings to straighten out how things worked afterwards. Remember, the IRS proposed, and this is still part of the reg, that if the amount you get as a credit is more than 15% of the value of the contribution, you have to reduce the contribution by what you received in exchange for it. This is the quid pro quo rule, that you receive something for the contribution, and we have to do an offset. There were two special rulings that the IRS issued that we're going to now incorporate into the regulations. The IRS believes that we should have these exposed and have regulations come up on it. The first one is Revenue Procedure 2019-12. For those who don't remember that procedure, it was the one that said, well, if you're a C corporation, essentially, that if you make a contribution to a charity and you get a tax credit, of course, you reduce the state or local tax. That's fine because you're not going to pay the tax. But you still get your full charitable contribution. Now, why is that true? Well, there's really two issues here. Number one, charitable contributions and the state and local taxes are going to be deductible. There is no $10,000 cap on the corporation's deduction for state and local income taxes. So we're going to go ahead and get the full reduction. We're going to treat it as charitable. And remember, charities are limited to 10% of AGI. So in reality, we're way better off. We'd have been better off had the IRS said that those were taxes and we needed to treat them as taxes. The fact we're treating them as charitable contributions is actually to the service's benefit. That ruling also said, though, that if the entity in question was a pass-through and the tax in question for which a credit was being granted was the income tax, then we have a problem. That credit for income tax is going to be considered to be a reduction of whatever the pass-through entity paid for that charitable contribution. So when the charitable contribution flows out on the K-1, the taxpayer has to reduce the total contribution by the value received from the credit, which basically wipes it out. Well, this will now become part of the regulations as proposed. The other ruling was Notice 2019-12, which was issued with the final regulations. This is the one dealing with those taxpayers who have less than $10,000 of state and local taxes and who made a contribution to a tax credit organization. And the argument was that, wait, these people aren't really abusing anything. You know, if they get a $500 charitable contribution, that's not a problem, because had they not made the contribution, they would have paid $500 more in state and local taxes, and they would have gotten a full deduction for that. So Notice 2019-12 had procedures about how you could get your deduction there. We'd be able to continue to get the charitable contributions up until the point that we would have gone over the $10,000 limit. Again, this is being worked into the proposed regulations. Also added in the proposed regulations, there was some clarifying language about when a business is deemed to have paid a payment to a charitable organization that is for ordinary business purposes. That's important because those would clearly be deductible above the line. So regardless of type of entity, if they're truly trade or business purposes, we get them above the line if they weren't charitable. And there's also clarification because it wasn't clear, and some people said the old regs didn't seem to make this totally clear, although some case law did, that what happened if you made a charitable contribution to organization A, and then some other organization, maybe a for-profit organization, gave you something for doing that. Like if you give $1,000 to, charity A, this restaurant B will give you gift cards equal to half of that. Well, they're saying that's still a quid pro quo and the reduction still has to be done. They kind of go after that by redefining just the word that deals with it, where it says if you receive goods or services in consideration for your contribution, and in consideration for, they just updated the definition to make it clear that amounts received in consideration for a donation count regardless of whether or not the charity that you made the donation to is the one that gave you the consideration. So all of that is kind of cleanup. But what was really interesting, and this was pointed out in an article that is published in the Monday's edition of Tax Notes Today Federal. The article is one authored by Amy Hamilton. It's titled IRS Silent on Pass-Through Workarounds in SALT Cap Proposed Rule. And in this particular article, which also describes how these proposed regs work, the things we just discussed, a number of professionals who were discussing what does it mean that the IRS had not mentioned any limitation on the use of the pass-through tax method of dealing with the workaround to the $10,000 cap. Well, the key takeaway from this, let's talk about this for just a second. How do those things work? Let's go to the Connecticut tax first, and we'll go there because we're going to say there's a Connecticut variant and there's a Wisconsin variant, because we have 5 states right now that have done this. Under the original Connecticut law, every pass-through entity in Connecticut is subjected to a tax at the entity level. The individual members of the pass-through entity, members, shareholders, whatever they may be, depending on whether we're talking about an LLC, a partnership, or an S corporation, they would each receive a tax credit against their Connecticut income tax liability equal to a percentage of the tax paid on their behalf by the pass-through entity. Now, that's different, of course, from the charity standpoint. The IRS had indicated early on that they were going to be looking at all of these workarounds for state and local tax, and even the first part of this year, they were indicating that they were seriously considering shutting down the other things. But as the article notes, midway during the year, IRS attorneys were suddenly indicating that they were studying the issue and they hadn't decided if they're going to issue any guidance or not, or how this is going to work. And now we get these regulations. It's a new set of regulations. They're coming down now. This would have been the perfect set of regulations on which to have put any such proposed restrictions on the pass-through tax, and they didn't. Now, I said there was two versions of the pass-through tax, so let's talk about version B, which is the Wisconsin version. Under the Wisconsin version, which also we've had no comment on, the entity essentially decides to be taxed like a C corporation. That means they pay an entity-level tax on their net income, but you don't actually report that income on the state income tax return. It's removed from federal AGI for state tax purposes. Now, the catch is in Wisconsin, as I noted, this is a volunteer. You volunteer to have your entity subjected to this tax. So we have the Connecticut version, which is the tax credit variant, mandatory tax credit variant. We have the Wisconsin version, which is voluntary, no tax credit, but no tax at the state level. Neither one of these has been directly addressed by the IRS. So the question becomes, we're now sitting what's going to effectively be, in a few days, 2 years past the time the Tax Cuts and Jobs Act was signed into law. On December the 23rd of 2019, we will be 2 years into this act. In those 2 years, we have not heard a word from the IRS about this. We have had plenty of discussion regarding the tax credits and why they don't work and why they're a problem. But we've heard nothing about this. That suggests that, does that mean the IRS has given up? Well, the article quotes a number of people who've commented in this area of suggesting that, yeah, it probably means that at this point, that the IRS should have done something by now if they were going to. It's going to be highly unfair if 3 or 4 years after the fact, the service suddenly says, oh, by the way, that whole pass-through tax thing, that didn't work, here's our theory. Assuming they have a theory, they probably should have proposed it by now. They haven't. That raises the obvious question of, are they just going to quietly ignore this thing and hope everybody's still afraid of it and, a lot of people don't claim the benefit of this? Why is the IRS in this position? My own take is they have a really, really tough time writing around this. I said early on, we first got the bill, that the tax credit issues were very easy for the service to deal with. If they were willing to sacrifice the existing programs, that is, if they were willing to say, you know what, I don't care that Arizona may have been running a program where you got 100% credit for donating to various charities, and we'd been allowing that as a charitable contribution and ignoring the fact you got your state tax refund, and we issued a chief counsel advice that essentially said that was okay. We're going to ignore that. We're going to say, A, the chief counsel advice has never been binding, so don't worry, but don't go to there. And B, we're going to also say that the law, things have changed now. In the past, the charitable contributions were actually more limited than the tax. That's a little disingenuous because if it's AMT was involved, that wasn't really what was true. But let's accept that was what was happening. We got something very different. And so because of that, we're going to go to straight quid pro quo, which to me always seemed like what should have been applied to these transactions anyway. The payment should have been considered a payment of tax as opposed to a payment of charitable contributions because, you were really paying the tax indirectly. The state said, as long as you give to something that, that we endorse, we'll go ahead and reduce your state tax liability by that amount. So, yeah, that was easy. This one, when we talk about the pass-through tax, nowhere near as simple. Now, I could certainly see the service going against either the Wisconsin or Connecticut bill standalone. And if we knew they wouldn't do anything else, and if that died, they'd give up, then maybe the service would do it. For instance, the Connecticut bill you could attack by saying that the credit for taxes given to the individual, well, that's obviously means that what the pass-through is really paying is Connecticut individual income tax, and as such, we should have to reduce it by the credit because they're just effectively paying a quasi-estimated tax payment for their partner. The flip side of that is on the Wisconsin one, well, there we don't have that problem. It's a pure entity tax. It's not, nothing showing up on the individual return, so we're not getting any state income tax liability that would exist to the individual. But there the IRS might say that there's no economic substance because it's voluntary. In essence, this is not a tax you have to pay. It's a tax you pay, and the only reason it makes sense to pay it is because you've determined that the next net tax benefit you're going to get from doing it this way is more than what you're going to give up by essentially having paid it at the top level, whatever it may be. And Wisconsin actually charges a bit higher rate if you do it this way, because they realize that, yeah, we can say, yeah, it's a higher rate, but you're still better off than if you actually pay the state income tax and try to claim a deduction. But the problem is if the IRS attacks either one of those, if they attack Wisconsin because it is voluntary, well, they just make it mandatory. And then I think the IRS has trouble. Similarly, if they attack Connecticut because of the credit, we get rid of the credit. We say we apply the tax at the entity level only, and we don't put it on the individual return, and I think we're fine there too. And those are much tougher to deal with because that's exactly what happens to every C corporation. You pay tax at the state level generally in most states, and we don't pick anything up on the shareholder's return. Those C corporations clearly get a full deduction. So it seems like, is there any requirement that the mere fact that for federal income tax purposes, we're not treating it as a C corp is, well, that's fine. Nothing says the states have to allow S corps, or nothing says they can't tax a partnership like a C corp. And the theory would be it would seem to work fine. I think they're going to have real trouble writing any reg that would effectively shut this down. Or more to the point, they'll have trouble writing a reg that will shut this down that would, not either wipe out pre-existing taxes that were not meant for this, like the California S Corporation tax or the New York City unincorporated business tax, or they're going to end up overreaching too. They're going to ban deductions for taxes that clearly are related to a trade or business and are being paid by the entity conducting the trade or business, not being paid by an individual. I think they're going to have a challenge based on the fact that they're kind of ignoring the actual black and white letter of the law. So I think the IRS, seeing this problem, has simply decided to give up quietly and not do anything. Now, could we be wrong? Yes. Certainly the publication of this article may force the IRS's hand. This is kind of speak now or forever hold your peace time if you're the IRS. Either tell us you're coming after this stuff or give up. You've got two choices. We may find they don't give up. They may release something. But as well, assuming they don't do anything, which seems to me like the most likely thing, we would expect a lot of states. Right now we have 5 states. We have Connecticut and Wisconsin already have kind of gone through a year at least with it, or a couple of years with it. But then we also have other states that enacted provisions that are going to take effect in Louisiana and, it was Louisiana, Rhode Island, and Oklahoma enacted provisions like this. And we have rumblings in a whole bunch of states that we are going to pass a bill that does something like this, that either adopts a Wisconsin, a Connecticut, or some hybrid version of the two taxes, and they're going to start implementing it right away. We would expect that by the time we get to doing 2020 returns, I wouldn't doubt that most of us that have states that have an individual tax and have an individual tax are going to find that we're going to have the pass-through taxes put in place there, and we're going to start losing the pass-throughs, either get a credit for the pass-throughs, the tax that was paid, or not pick them up at all. And this trend is going to accelerate if the IRS doesn't say anything. So even though right now you might say, well, I'm not in any of those 5 states, don't worry about it, you probably need to start worrying about it in the future because I think it's going to become a serious issue. Right? Those 5 states have laws on the books. We have more to come. So advising your clients right now, my take is tell the clients the IRS clearly indicated they didn't like this, but they also haven't done a darn thing. And they stayed quiet, and they've issued tons of guidance on the other thing. So bottom line, I suspect that we're going to be okay. We might want to disclose just in case the service tries something down the line. So we'll say, look, we disclosed, this is our position. You guys hadn't said anything, so this is how we went forward. But yeah, it's going to be interesting. It's very different than a year ago when we were still thinking the service might do a crackdown. And so you might have backed off some. Now it's more like maybe you go ahead and let it go. But again, please remember, it is the client's decision, not our decision. We simply tell them where things stand, and they're the ones ultimately that decide how risky of a position they like to take. Finally, what a lot of you will consider good news, the IRS released this week Notice 2019-66 issued on December the 9th. This notice makes changes to what's going to be on the Form 1065, the K-1. In fact, we have a new draft K-1 that now incorporates this particular change on the face of the K-1. On the original draft K-1s for the 1065s for 2019, the IRS had only put at the bottom, it said partners tax basis capital. So the partners capital account on the bottom of each K-1 had to be their tax basis capital. Based on the IRS's frequently asked questions page, the IRS was intending this to be inside basis. And if need be, inside basis was computed as you would do it if you had a 74 election in place, you had a purchase of a interest by an outside somebody, a partner sold to somebody else, and we're going to make that 74 adjustment. We had to compute the inside basis by essentially figuring out what this buyer would get in liquidation, subtracting from that the gains that they would have recognized, and adding back the losses that would have been allocated to them. And if you think about it mathematically, that kind of has to work out as inside basis. That's their share of the inside basis. Well, that's basically the number the IRS wanted to be tracking every year for each partner. And they did offer up a safe harbor that said, well, if you don't have that, then what you could do is effectively, at least they did for the negative basis reporting rule that we had for the 2018 returns. They said that you could just take, if you know the outside basis, you know the actual basis of their interest, you could take that basis of interest, subtract off any debt that was allocated to them, and that was what you use to determine if they went negative, and if they're negative, you'd put a notice on, and you would inform the taxpayer and the IRS that you were using this intermediate step, which isn't really tax basis capital, but hey, we're working it for what it's worth. Well, the IRS has now said that requirement to use tax basis capital will be delayed by 1 year. And in fact, now the K-1 that they just issued, the new revision, just says partners capital account. Doesn't say under what method. So you'll be allowed to use any of the methods you were allowed to use in the past, can be used on the 1065 for 2019. However, you will still have to inform the IRS if any partner had a negative capital account balance on the tax basis to begin the tax year or ends up with a negative capital account balance at the end of the tax year. That information still is required to be disclosed. You didn't get out of that. So you're still going to have to compute tax basis capital unless you are sure no partner has negative tax basis capital. There are some cases where you probably can be sure. There are other cases where it's not going to be clear until you actually back into things to see what happened. They did remove some additional information, though you'd have to submit for at-risk activities. Although what's interesting is the S-Corps had the same rule, and this ruling doesn't mention S-corporations not having to provide that information. Again, article in Tax Notes this week, it was suggested it's not clear if that's an oversight or if it's real. They really mean S-corporations have to do the information. But right now, we got to assume that S-corporations will have to give out all that additional at-risk information, and partnerships can just give out what they had to give out in the past. They also kept the requirement to give beginning and ending 704C information. Now, in the interim, the IRS suggests they're going to be asking for the next year for more guidance on what exactly, people think they should do about how to compute tax basis capital, some clarifications on definitions and the like. It certainly appears the service plans to move forward with this at some point, but it also appears that we've got at least a reprieve because there was a lot of protest going on. AICPA wrote letters asking for it to roll back. All four of the big four signed a joint letter asking for this to be moved back. So the IRS got a lot more pushback on this than I think they expected. So they've gone back, but they're still saying this is only good for 1 year. After a year, we're going to come back in and ask you to tell us what your tax basis capital is, not just for those who are negative, but for everybody. We're getting to the very end of the CPE season now. In fact, I'm going into this week. I will do my last sessions live, not rebroadcast live, but live before the end of 2019. After that, I take time off. We go ahead, enjoy the holidays, get ready for New Year's, and after New Year's, ramp up again and start doing more sessions. So this week, if you're listening early, you're listening here on the weekend or you listen on Monday, you've got a couple of options if you're early enough. On the 16th, which is Monday, I will be in the Phoenix office of the Arizona Society of CPAs. I'll be doing in the morning a 4-hour session on Arizona accountancy ethics, the thing you have to take in order to renew your license every 4 years. In the afternoon, I'll talk about an update on Arizona tax update and overview, including looking at what the legislature did this year in order to, with the changes with conformity to deal with Arizona taxes. Those changes take effect for the 19 returns you will be filing. So we have a lot to talk about there in the course. Finally, on the 17th, I will do the current federal tax developments broadcast. That'll be a full 8-hour session. We'll talk about what's happened in taxes this year, what may happen in the near time. As I'm recording this weekend, there have been reported that there are discussions going on right now that may or may not result in some tax legislation being attached to the spending bill that supposedly will be presented for a vote this coming week. If that happens, because I'm told that we're supposed to have everything to get the text out and the vote scheduled, I think, for Tuesday, and so they'd have to have the text out like 24 hours ahead of time. So basically, we have a deal before I got to the course on Tuesday. If we have it, we're going to discuss about what's in the deal, assuming we can figure out that information, which we should be able to by being published by that point. And then we'll try to talk about anything else that may have happened. So we'll talk about all the updates for the year. Both of these are available either going to the Society offices on Monday and Tuesday, or take them via webcast wherever you may be. If you want to sit back and listen to this, they'll start at 8 a.m. Mountain Standard Time. That would be 7 a.m. Pacific Time, and it'll be 6 a.m. if you're in the Eastern Time Zone. So that's where you are. That's adjusting so you guys can get used to how Arizona time works, because I know that confuses everybody because we don't move our clocks. And this has been the current federal tax developments for the week of December 16th. You can follow our updates regularly on the website at currentfederaltaxdevelopments.com. You can send any questions or comments to me, Ed Zollers at currentfederaltaxdevelopments.com. You can follow me on Twitter. There you'll find me as at Ed Zollers on Twitter. Also follow discussions on Reddit. I do that /r/taxpros. I'll look in there for some discussions. I also tend to follow discussions on the Arizona, Minnesota, and New Jersey Society websites, on the Connect sites. So if you're in there, you ask a question, I may respond if I think I can be helpful. I also take a look in at California Society's Tax Talk group. So if you're involved in that, fine. That one is actually open to any CPA around the country. So wherever you are, you can sign up for that. It's going to be an interesting week, especially if we do get new tax provisions. And so it's possible, I'll put it this way, if we're going to get new tax provisions before the end of the year, it's almost certainly going to be in the package that's going through to continue the government next week. Because again, the government, as my understanding, runs out of money on next Friday, or this coming Friday, I should say. So on the 20th, they run out of money. So we're going to have some package put through. If that spending bill goes through, then if we're going to have a tax bill, now will probably be when we have it. If we don't get a tax bill then it's highly, my guess is we're not going to see anything until after the election. So that's my take. Maybe totally wrong, but we'll see how it goes. In any event, join us here next week where we'll tell you what's happened with regard to any new tax bill, as well as any other developments here in the area of federal tax.